Okay, let's unpack this. Welcome back to the deep dive.
Great to be back.
If you've been tracking with us for the last few months, you know we've been following a very specific, and I'd say very dramatic, story in the Malaysian market. We've been tracking the saga of XIS REIT.
It really has been a saga, hasn't it? I mean, it hasn't been your typical collect rent and pay dividends kind of year for them.
Not at all. And today, we are looking at what feels like the season finale.
It really is.
We're talking about the full financial year 2025. The Q4 report is out, the full year numbers are in, and we finally get to see, did they stick the landing?
This is the moment of truth, for sure.
Because, let's be honest, it has been a roller coaster. Remember our deep dive on Q2? We called it the split personality quarter.
Right, the Jekyll and Hyde dynamic. We saw operationally strong numbers, high occupancy, good rentals, but the cash flow was flashing all these red warnings.
Yeah.
We were seeing profit on paper, but the actual cash hitting the bank account was looking a bit thin.
And then Q3, that was the real nail-biter. We talked about the debt cliff.
Oh, yeah.
That massive RM $787 million in short-term debt that was just looming over them.
And the cash burn. We were genuinely worried about liquidity and how they were going to refinance in a high-interest environment without, hurting the dividend.
So the mission today is simple. We're going to look at this final report for 2025 and answer the ultimate question. Did XIS REIT pull it off? We've got record-breaking profits, a massive new acquisition pipeline, including what I'm calling a whale of a deal, and, of course, the inevitable legal drama.
And a brand new tax headache that I think almost everyone missed in the fine print. That one is a bit of a sleeper agent.
Oh, we are definitely getting to that. But let's start with the headline numbers, because if you just look at the top line, it looks like a victory lap.
It really does.
I mean, look at this. Full-year revenue for 2025 hit RM $364.2 million. That is up 13.8% year-on-year.
And for a real estate investment trust double-digit revenue growth is nothing to sneeze at. That is significant.
No.
Usually REITs are slow and steady, tortoises, not hares. This is a sprint.
And the realized net income, this is the number that really matters for the dividend, right?
Correct. In REIT terms, realized net income is the proxy for your distributable cash. It's the money they actually have available to hand back to you.
It jumped to RM $205.0 million. That's a massive 25.9% increase from last year. And the payout, the DPU settled at 10.55 sen.
Last year, it was only 9.27 sen.
That's a huge jump.
That's a 14% raise for shareholders. I mean, in this economy, getting a 14% hike in your payout is exceptional.
Exactly. If I'm a shareholder, I'm looking at that 10.55 sen, and I'm thinking, time to pop the champagne.
Like that.
And there's always a but with you. Should I be popping the champagne?
You can have a glass, maybe not the whole bottle just yet.
Why not?
Because as we always do here, we have to look at why those numbers jumped. It wasn't magic, and it wasn't just business as usual. It's a combination of aggressive expansion and one very specific strategic move that maybe distorts the picture a little bit.
You're talking about the acquisitions.
Partially. We call it accretive growth. That 13.8% revenue jump is largely because of the RM $719 million worth of acquisitions they completed back in FY24.
Right, the hypermarket in Temerloh and those logistics hubs.
Exactly. Those properties are finally contributing a full year of rent.
So they bought income streams, basically. That's the business model.
Precisely. But there's another layer to that RM $205 million profit figure. Do you remember the Annex?
The property in Petaling Jaya.
Yes. They sold it in April 2025. That disposal generated a realized net gain of about RM $8.8 million.
Yeah.
Now, here is the technical nuance. Because of how REITs work in Malaysia, realized gains from selling properties are distributable.
So a chunk of that record dividend isn't from collecting rent. It's from selling the furniture, so to speak.
In a way, yes. It's capital recycling. They sold an older asset to pay out cash. That RM $8.8 million boost is a one-off. It doesn't happen again next year unless they sell something else. So if you strip that out, the dividend is still good, but maybe not as spectacular as that headline number suggests.
Okay, that is a crucial distinction. It pads the stats for 2025. But surely there's some organic growth in there, too.
Yeah.
They can't just be buying and selling their way to these numbers.
No, and to give credit where it's due, the engine is running well. They achieved positive rental reversions of about 3.5% for the year.
Let's define that for the listeners. Rental reversion.
It simply means the change in rent when a lease expires and is renewed.
Got it.
So a positive 3.5% reversion means, on average, when a tenant's contract ended, AXIS convinced them, or a new tenant, to pay 3.5% more.
which proves that demand for their warehouses is still there. They have pricing power.
Exactly. It proves the organic engine is working. However, I noticed you looking at the Q4 specific data earlier with a bit of a frown.
I was. Because if you zoom in just on the last 3 months of the year, the revenue actually dipped, down 2% compared to Q3. That feels like a hiccup in the victory lap.
It is a hiccup, and it's important to acknowledge. That dip was driven by lower occupancy in Q4. It dropped to roughly 89%.
And management cited tenant consolidation.
Right.
That sounds like a polite corporate euphemism for tenants left.
Or they downsize. I mean, in the logistics world, sometimes a tenant realizes they don't need 3 warehouses, they only need 2. It's a reminder that you aren't immune to vacancies.
Right.
And at the same time, expenses ticked up.
Why? I thought they were scaling up. Usually scale brings costs down.
2 reasons. One, they spent more on CSR corporate social responsibility, which often happens at year-end. But the other one is structural and a bit annoying for investors.
Which is?
As of October 1st, 2025, the government imposed the SST sales and service tax on manager fees.
Ah, so the fees they pay to the REIT manager now get slapped with a tax.
Correct. And that is a cost that cannot be passed on to the tenant. It hits the bottom line directly.
So Q4 showed us costs are creeping up and tenants can leave. A reality check.
A reality check that margins are under pressure, yes.
Speaking of reality checks, we have to talk about the elephant in the room. Or maybe I should say the ghost in the room.
You mean the Yongnam Saga?
The Yongnam Saga. We warned about this in the Q3 deep dive. We said, hey, there is this RM 105 million stray claim against a former tenant, and it looks shaky.
We did.
What is the verdict in this final report?
It is bad news. I won't sugarcoat it.
Give it to us straight.
Okay.
Because RM 105 million is not a small number. That's like half a year's profit.
It is. So here's the situation. AXIS REIT technically won. They obtained a default judgment against Yongnam Engineering and Yongnam Holdings.
Okay.
So legally, the court says, yes, they owe you that RM 105 million.
Okay, so they won the battle. They have the piece of paper.
But they have lost the war for the cash. The report confirms that liquidators were appointed for the Yongnam entities in February and August 2025.
Liquidators. That's the end of the line, isn't it?
Essentially, when liquidators are called in, it means the company is dead. It is being stripped for parts to pay off creditors.
And landlords are not at the front of that line.
They're at the back of the line. Secured creditors' banks get paid first, then employees, then the tax office. Unsecured creditors, like a landlord claiming future rent, are last.
So that RM 105 million?
It's highly doubtful they will recover it. I mean, the management's language is careful, but investors need to read between the lines. That money is likely gone.
Wow.
We are probably looking at a massive write-off.
That is a huge hit to the book value, just waiting to happen.
It is. It won't affect the cash flow directly, but it hits the net asset value. It makes the company worth less on paper.
Okay, so we have a ghost tenant, but you mentioned something else earlier. A blink and you'll miss it detail about taxes. I'll be honest, I missed it. Note B9.
Note B9. This is the kind of regulatory gray cloud that markets absolutely hate.
What happened?
So for a long time, Malaysia has had a specific incentive for foreign investors in REITs, a withholding tax concession.
A lower tax rate on their dividends.
Basically, yeah.
Yeah.
To make Malaysia attractive compared to, say, Singapore. It was a sweetener. But that concession had an expiry date, December 31st, 2025.
Okay. And did they renew it?
As of the date of this report, the Ministry of Finance has not extended it. It's just gone.
Ouch. So if I'm a foreign fund manager sitting in London holding XIS REIT, my tax bill just potentially went up.
Significantly. And the worst part is the uncertainty. Will they bring it back? Will it be retroactive? We just don't know. And markets hate, we don't know.
What does this do to the stock price?
It could dampen interest from foreign funds. I mean, if the yield becomes less attractive after tax, they might rotate their money elsewhere. That puts selling pressure on the stock.
That is frustrating. So we have the Yongnam write-off looming. We have a tax policy in limbo. Yeah. You'd think the company would be hunkering down, playing defense.
You would think that would be the traditional play.
But they aren't. They are pivoting to offense in a huge way.
And that is the fascinating contradiction of XIS REIT right now. Despite all these risks, they are pressing the gas pedal on growth.
Let's look at their portfolio. They ended the year with 69 properties, just added Axis Facility 4 at Bukit Raja.
And they completed the Northport facility acquisition in January 2026.
That was RM 50 million.
A nice, solid addition. But that's small potatoes compared to what they announced in November.
The Whale.
The Whale.
They accepted a conditional offer for an industrial property in Penang. The price tag, RM 800 million.
I want the listener to just pause and process that number. RM 800 million.
That's huge.
To put that in perspective, AXIS REIT's entire market capitalization, the value of all its shares, is around RM 4 billion.
So this one single acquisition is equal to 20% of their existing value.
In one go. It is massive. It completely changes the scale of the company.
Why that big a bet on one site in Penang?
It's a bet on the Silicon Valley of the East narrative. Penang is booming with semiconductor and electrical manufacturing. This isn't just a shed, it's a high-spec industrial facility.
A massive, medium-term growth leg, as the analysts say. But it raises the most important question of all. How do you pay for it without drowning in debt?
That is the billion ringgit question.
We talked about their debt cliff in Q3. Where do they stand now on gearing?
Currently, their debt-to-asset ratio is at about 32.4%.
That sounds comfortable.
In the REIT world, anything under 40% is generally safe. The regulatory limit is 50%, but you never want to get close to that. So yeah, 32%, they have headroom.
But can they borrow another RM 800 million?
RM 800 million plus the other deals would likely push that gearing well over 40%. And that starts getting into the danger zone.
I saw a quote from the CEO, Leong Kit May, in The Edge. She was pretty blunt about this.
She was. She explicitly said that they are comfortable now, but, and this is the key, but if the gearing breaches the 40% mark, they will pull the trigger on equity fundraising.
Okay, let's translate that. Equity fundraising. In plain English, that means selling new shares.
Exactly. Placements. They will print new shares and sell them to investors to raise cash.
And for existing shareholders, that means the dreaded D word.
Dilution.
Dilution.
Right. Think of the company as a pizza. Right now, you own one slice. If they create new slices to sell, your slice represents a smaller percentage of the total pizza.
Unless the new, bigger pizza is so much more valuable that your smaller slice is worth more.
That's the gamble. They're betting the income from the RM 800 million property will be high enough to offset that dilution, but stock prices usually drop when placements are announced.
Usually, yeah, supply goes up. So the listener takeaway here is, the growth is exciting, but it comes with a cost. You might get diluted.
That is the trade-off. They're keeping the balance sheet safe by asking shareholders to chip in. It's prudent management, but it can weigh on the stock price.
Speaking of the stock price, it's been hovering around RM 1.98, RM 2.00. Why is the market not rewarding this record profit?
It's the price puzzle. And the analysts are split on this, which tells you how complex the whole situation is.
Okay, let's run through the analyst scorecard. Who are the bulls?
RHB Research is the bull here. They have a buy call with a target price of RM 2.42.
That's nearly 20% upside from here.
Yeah. They see the Penang deal as a total game changer. They think the market is too focused on the risks and is missing the growth. They even add a 2% ESG premium to their price.
For their green buildings and solar panels and so on.
Exactly.
Okay, so RHB says buy the dip. What about the middle ground?
That's Kenanga. They have a market perform, basically a hold, with a target of RM 2.02.
So right where it is now.
Pretty much. They like the 14% DPU boost, obviously. But they are cautious about the supply side.
The supply of warehouses.
Yes. There are a lot of new industrial warehouses being built in Malaysia right now. Kenanga is worried that supply might outstrip demand, which would hurt rental rates.
And the bears.
Public Investment Bank is the most cautious. They are neutral with a target of RM 1.96. Their view is, look, the results are in line, but we aren't chasing this rally.
So the consensus is operationally strong, but the market is scared of the macro environment.
Exactly. The company is doing its job, but the world around it is getting tougher.
All right, it is time for the verdict. In our Q3 deep dive, we introduced the financial Moat Scorecard. We gave AXIS REIT a 710 back then.
We did. We felt the business was solid, but the debt and legal baggage were holding it back.
Now we have record profits, an RM 800 million lawyer deal. I'm tempted to bump it up to an 8 because of that revenue growth.
I hear you. The growth is tempting. But I've looked at this from every angle. The operational metrics are up, but the risks we talked about haven't gone away. They've actually crystallized. I am keeping the score at a 710.
Sticking with the 7. That feels harsh given the 25% profit jump. Walk us through the justification.
Okay, let's start with the good why it's not lower. Their business moat is undeniably wide. They have unmatched scale in Malaysia, 70 properties soon.
Right.
They prove they can recycle capital by selling the Annex at a profit. And they delivered a double-digit DPU increase. You cannot ignore that.
Okay, so the core business is strong.
Very strong. They are the king of the hill, but the financial anti-moat factors are dragging them down.
Let's hear them.
Number 1, Litigation risk. That Yongnam write-off is a ticking time bomb for the book value. It hasn't hit yet, but when it does, it will be ugly.
Number 2.
Tax uncertainty. That withholding tax expiry is a regulatory gray cloud that we just can't shake.
And number 3, the dilution.
The capital call risk. Funding that RM 800 million Penang deal will likely require equity fundraising. That caps the share price upside because everyone knows new shares are coming.
And finally, that little Q4 hiccup.
Occupancy. The slight dip in Q4 just shows they aren't immune to tenant consolidation. They aren't invincible.
So 710, a strong business with some heavy baggage.
A very strong business carrying a heavy backpack. It can still climb the mountain, but it's going to sweat a bit more.
I like that analogy. Okay, before we sign off, what is the final provocative thought for the road?
If we connect this to the bigger picture, XSS REIT has proven, without a doubt, that it can grow income aggressively. They are very good at buying buildings and collecting rent. But with an RM 800 million acquisition on the horizon and a tax policy in limbo, the question for 2026 isn't, can they make money?
What is it?
The question is, how much will it cost them to fund it?
That is the key.
Yeah.
Is the cost of capital through dilution or debt going to eat up the gains from the new property?
Exactly. Growth is great, but profitable growth that flows to the shareholder after financing costs is the only thing that really matters.
So, call to action for you listening. Check your own risk tolerance for equity dilution. If they announce a placement, are you okay with a smaller slice of the pie?
And definitely watch the news for the Ministry of Finance's decision on that REIT tax exemption. That is a sleeper issue that could wake up fast.
Absolutely. Keep your eyes on the fine print. That's it for the season finale of the AXI REIT saga for now. Thanks for listening, and until next time.
Keep diving deep.